Hey everyone, Cody here. So we've talked a lot in the last couple weeks about how much auto loans and vehicle costs can impact our financial futures and our current financial situation. So I wanted to put some numbers to this so you can see exactly how catastrophic some of these vehicle situations are. The average auto loan these days, 68 months, and loans as long as 96 months are being offered, which is just an astounding number. We talk a lot about if you are going to buy an expensive vehicle, you need to find a way to fund this in cash or pay it off very quickly because those costs are just catastrophic. One of the reasons those costs are so catastrophic is that the loan is so long and the interest rate is so high. So if you have a 750 plus credit score, the average interest rate, whether new or used, kind of evened out, is about 10% right now. If your credit score is below 600, that average interest rate is over 20% right now. And so when we look at this and we say, okay, a 68-month loan, and I've got a credit score below 600 and I'm at a 20% interest rate, massive, massive numbers were thrown out the window in interest on a depreciating asset. And what we see then is people get into these really bad, really long loans and the vehicle depreciates faster than what we pay it off. And so we're seeing more and more of what's called negative equity. You've probably heard this talked about. Average negative equity in the last 4 years has risen 60% from $4,100 to $6,800. So we look at this combination of long loans on a depreciating asset, creating negative equity at a high interest rate, and all of those factors just make these vehicle loans catastrophic. We have to find a way to control these vehicle costs and make sure we're getting in vehicles that we can actually afford.